So for the next hour, and will be really the next hour, no more than the next hour, because Mariela has a flight and I don't want her to miss the flight, so she has to be out of the building by 5:30. So we are going to cover together IFRS 10 to 12 that are considered the revision of how to treat investments on a consolidated basis by an investee or controller in the case of consolidation. So I will talk initially about IFRS 10, and Mariela will then cover IFRS 11 and IFRS 12. I guess the first comment, the interesting comment, is that within those the projects that led to this set of 3 IFRSs, the board decided to consolidate all the disclosures related to investments in companies in one standard. This is IFRS 12. So IFRS 10, the one that I will cover shortly, it basically brings, firstly, it doesn't change much, consider what is required in terms of mechanics to be consolidated, or what is consolidation, what is the purpose of consolidation. But compared to IAS 27, the former, the predecessor standard that applied to consolidation, but actually it concentrates aspects of identifying the investment or the control over an investment, and what should be considered, all facts and circumstances that should be considered when assessing control, basically. And then disclosures that we had in IAS 27 regarding investments, they are all consolidated in one standard only. We understood it's easier. So in this first 20 minutes or so, I will stress 4 aspects of IFRS 10. First, because Mike started yesterday talking with you about the conceptual framework, we thought it would be interesting to somewhat identify the link between the IFRS 10 and the conceptual framework. Apparently, this could be interesting in every standard that we develop, especially when we talk about the standard itself. But we didn't do for the other topics, but this in particular we do because of the concepts behind the consolidation. Second aspect is why we issued IFRS 10, and we could consider IFRS 10, 11, and 12. The reasons are quite similar. The main features of IFRS 10, and in the conclusion, a brief summary of IFRS 10 and the interaction between these 3 standards, 10, 11, 12, an interaction with IFRS 9 and also IAS 28 that still exists. So the first is the aspect is the link with the conceptual framework. If you do remember or recall our friend Mike Wells yesterday talking about decision making and the objective of financial reporting under the perspective of the IASB, we mainly focus on the use of financial reporting by the users in the decision making process. And one aspect is that the most important aspect, this must be useful for those users. We do acknowledge that many users, outside many stakeholders that have a keen interest in financial reporting, but in our conceptual framework, the users are the ones who provide the resources to the entity. And the core principle in IFRS 10 is that for a user, when assessing a group of entities, it's important for them to have a view of the information regarding the group itself, not only the assets, but also the liabilities associated with those users. So why we issued IFRS 10 firstly? There were two aspects in IFRS, in our previous standards, that were under scrutiny, I would say. First, it was what we called inconsistency in practice between IAS 27 and the interpretation 12. Because IAS 27 used the concept of control since inception. But then, following the request for clarification with regards the consolidation of special purpose entities, the then called SPEs, we now call those SPEs as structured entities. The interpretation committee put a lot of focus on the risks and rewards aspects associated with special purpose entities. Then, considering the focus of the interpretation committee on risks and rewards and the focus of the IAS 27 on control itself of the company, lots of structuring opportunities appear to be in place in many countries, because then people started to structure arrangements and investments in entities considering the risks and rewards aspects and not consolidating those entities. This was one of the issues. So we didn't have a consistency in application of IAS 27 or the consolidation requirements. The second aspect, and this was very much indicated during the crisis 2007-2008, was the lack of sufficient disclosure, particularly associated with special purpose entities. So generally, supervisors acknowledge that apart from the inconsistency that I identified between the control concept and risks and rewards aspects, IAS 27 or IFRS literature worked well during the crisis. But they felt that we had a problem in the level of disclosure, particularly with special purpose entities, and also with regards to investments that were not controlled by the entity. Mariela will talk a little bit about the disclosure, of course, but one aspect that you will identify is that now in the disclosure, we also require disclosure on judgments applied when assessing control. Not only disclosure is associated with the investments and the controlled entities, but also how the judgments were conducted and the results of those judgments. For the ones who are bank regulators, you surely might recall about reputational risk discussions within the banking regulatory community. Should reputational risk be included as an assessment of risk under the operational risk capital requirement, for instance? If I'm not wrong, Basel II is very explicit with regards to reputational risk, and reputational risk is not included or should not be included in calculation of operational risk capital requirement. So what we did, and the solution we found was IFRS 10 and IFRS 12. IFRS 10, as for the inconsistency, IFRS 10 established a new single model for consolidation. And the model is based on control. And we understand that now we have a clear principle of control and lots of additional guidance. If you go to IFRS 10, as published today by the IASB, there are more examples than descriptions, actually. We have lots of examples and real examples that were brought to us by many commentators, many stakeholders, and we try to clarify them. As for the disclosures, we have IFRS 12 with what we believe are enhanced disclosures, and then providing much more information, the useful information for users in general. It's important to recall that this set of IFRSs, they became effective in 1st of January 2013. So they just, they are in place or are effective from the 1st of January this year. We are going to assess the effectiveness of these statements following in the future, following our requirement under the post-implementation review basis. But so far, we believe they responded well, and this was the feedback we received from regulators and from stakeholders during our due process and our discussions. So the main features of IFRS 10 that are important to consider is that what's the scope of a single consolidated model? Basically, in this slide, the investor or entity A, if they control, or every and single entity that is controlled by the investor should be consolidated. This is under IFRS 10, and this will generate a group consolidated financial statements that is, in this simple example, is composed by entities A, B, and C. If there is no control over the entity, the investment is an asset and treated accordingly, being a joint operation or a single investment in the financial reporting. So the scope continues to be the consolidation of all controlled entities. And the control model has three features that should be considered. The power to influence or to influence the decisions associated with relevant activities. An additional aspect is the exposure or risks to variable returns and the link between these powers and returns. The most simple situation is when someone has the majority of the voting rights, because power generally is directly associated with voting rights. That was not the problem generally when discussing consolidation. The problem when discussing consolidation is that when these voting rights or the power to direct what we call the relevant activities is not very clear, and of course is what we try to avoid. We try to avoid situations where the complexity of the structure is such that it's very difficult to assess who controls effectively the entity, and eventually no one consolidates the entity. So we try to build or to provide more clarity around more clarity and guidance when assessing control of an entity in order to require the consolidation. So there is a clear definition of control in IFRS 10, and the definition is this that is presented there. And there are a couple of words that myself I think are very important. One is how exposure or what sort of rights to variable returns an entity or an investor has, and the ability to affect those returns through the power over the investing. Generally, when applying this definition is, I would say, at least in my experience, in the banking sector, on the regulatory side, it's almost always easy to identify who controls the entity. In our experience, as I mentioned this morning, in Brazil, they had three types of consolidated financial statements. One that is IFRS, is used for public to publish financial reporting, but the supervisor has two additional consolidated requirements, and one of them is called economic consolidation, and this consolidation goes far beyond what IFRS requires, and this includes, for instance, if a member of the family of the controller of an entity is also the key management personnel in another entity, although they have no direct interest, they might be generally, as a rule, be consolidated under one group until it's proven they are not linked. If they are from the same family and they do business together in a third company. So there are lots of requirements, but this is used only for supervisory purpose. It's not used for other aspects apart from an assessment and monitoring from supervisors. This is not the case. Yes.
I wonder if when there in the definition we use the words investor and investee, but I wonder if the power exists but there is no actual investment. For example, the power is by some contract, or it is just like that and we know that it is like that. Do they have to consolidate? Do we consider that it is control? Or for IFRS it is not, but for regulatory purposes it is?
In IFRS you have to have an investment first. So in your example, apparently there is no investee-investor relationship. That's a good example. So under IFRS there is no consolidation because they don't have a relationship being an investor and an investee. In the case of Brazil, for supervisory purpose, if the supervisor believes there is an additional feature outside of this legal structure that actually provides the control over the relevant activities of that entity by this entity, for supervisory purpose, they generally require consolidation because they are viewed as actually as a group acting together. But this is not IFRS, I would say. Yeah. Yeah.
Even if it is not investor and investee, they have to consolidate.
I do not recall exactly the IAS 27, but if you say so, yeah. So you?
My question is, if that is only that formal part, that, for example, if one company had $5 investment and all those three conditions are met, we would consolidate because there is $5 investment. If that $5 investment does not exist, so don't you think it's not substance over 4?
No, sorry. You can control indirectly. I don't know. Yes. If you do control, sorry. If you do I was with my mind in another environment. If you do control even indirectly through another entity, yes, you do consolidate. In this case, yes.
Indirectly is also by power. Just because one person is significant, he can power, we consolidate.
Yes. So the key in IFRS 10 is the power over the investee. And the power is characterized by, we provide some additional factors, guidance, and at some point, if you are not really able to consider or to envisage very clearly following the facts that are available to you, that you are unable to identify the control, we require to use all facts and circumstances. In other words, you can identify or you can consider wherever factor you do have available to you in order to assess who controls, in fact, the entity. We do understand that it's almost impossible to identify all situations and circumstances associated with this arrangement between companies and a set of groups. Because when it's easy, there's no need actually to additional guidance. But the problem is when it's not very clear. And when it's not very clear is where we try to provide additional guidance or at some point require that you consider all facts and circumstances.
the only struggle it brings those words investee and investor. What if they are not investee and investor?
So you have to consider again in the case that you have in mind, you have to consider the facts and circumstances that are available to you. So you might have something on your mind that I'm not clearly envisaging. So you have to consider all facts and circumstances and who controls in fact that entity. If someone controls and you can prove that someone controls, you are required to consolidate.
He will become the investor.
Under the?
He will become the investor.
He will become the investor because
even if he has not any share in this.
Any direct share in this can be through the indirect investment.
And even indirect investment, there is no, but everyone knows that this person can influence to this company.
No. Following the IFRS, no, you are not required to consolidate because you have to have an investor. Well, that's where my mind was when she asked it, because my previous experience for supervisory purpose, we do require this. We could require such consolidation.
It can be the power according to which the creditor of the company could restrict some large contracts of company. Company cannot provide the dividends, cannot make good large acquisition, etc. And it is the control. It's the problem that according to IFRS, it is not going to the.
We have.
It is not investment.
If you do not have an investment, you might have to consider other contractual arrangements. So you can have bonds, not only equities, the bonds that give you this sort of power over the entity that then requires you to consolidate. It particularly is important in the banking industry when the bank issues for tax purpose or benefits issues a number of bonds that are held by third parties that do not have equities, but through the bonds and the sort of contractual arrangements within the bonds issuance, they do have in fact the de facto control. So
under the definition of investor.
exactly, they will in this sense, yes. So basically, there are four main aspects in IFRS 10 that are important to bear in mind. Well, the first is the de facto control. This is the most important one, as we've been discussing. So anyone can control. Now is more, although in IAS 27 it was actually acknowledged that someone could control with less than 50%. Now with IFRS 10 it's very clear that someone can control with less than 50%. Yes. There, over there. Okay, I'm just well, in Brazil they have IFRS, economic consolidation, and a consolidation that they call operational consolidation. So this operational consolidation can capture anything that the supervisor believes should be under the same group. So for instance, if by chance your husband is the main shareholder of Bank A, and you by chance is the main shareholder of Bank Z, and they have no direct relationship, they might understand that, well, actually this couple are running the same business, this is the same group, so we would like to have a look in this group as a whole. Or could be your brother. Generally they consider until the second level of relatives, yes. Could be the law used it to be even very, very strict and consider at the third level or so, something that goes to cousins. And so this is the type, but this is not IFRS. Well, and under the de facto control, you consider aspects that are generally the ones that we consider: the size of the holding relative to others, particularly when there is that dispersion, and you do have the power even with a lower, less than 50% of the voting rights. The potential voting rights that you have and could be exercised when the decision needs to be made with regards to, again, relevant activities. Other contractual rights that eventually we can have contractual rights among investors that gives one particular investor the power to control the relevant activities. And finally, because we cannot envisage, as I told you, envisage all the circumstances, all the potential arrangements, we require to consider additional facts and circumstances that provide evidence of power. One aspect is statutory entities, also the special purpose entities that we had in the interpretation 12, as mentioned specifically as special purpose entities. Now we call all of them statutory entities. This is the new terminology for them. There is no particular requirement for them. Should be applied the same general principles that we have in IFRS 10 for statutory entities as well. As for potential voting rights, some aspects that should be considered when when assessing potential voting rights. Consider the substantive ones, and actually the rights that can give the holder the power to influence the relevant activities, and should be considered all terms and conditions. And we mentioned some that we believe are important. One is eventual barriers that could prevent the holder of exercising his power. In some places they call, for instance, the golden shares that give someone the power to control the activities, but for some, the most important aspects of the day-to-day, I would say again, the relevant activities, they might prevent this holder to decide, so this should be considered. How beneficial to the holder those rights, the exercise of these rights would be. And one aspect that I particularly find very important: if I can really exercise those rights when the decisions need to be made. If I do have the rights written in a paper or a contract, but when they need to be made, I cannot exercise these rights. They are not really my rights to control, or does not represent control of the relevant activities. And the fourth point of the main decisions associated with IFRS 10 was related to agents' relationships. Now we provide more guidance, particularly for situations when there is an agent and principal relationship. This was particularly important in statutory entities or statutory activities. And then we consider the scope of the decision-making authority. Who holds the authority in the decision-making process? Is the agent or is the principal? The one who holds the power or the right is the principal, not always. This was particularly important when we have asset managers structuring entities on behalf of third parties. What sort of rights the other parties have, particularly one that was brought to our attention, that's called kick-out rights. So if you are not performing according to my wishes, I can simply kick you out of this of our arrangements. The remuneration, in some cases, is important to identify what are the main features of the remuneration process on the decision making, if they are subject to an assessment of the returns provided by the structure itself, or what sort of agreements they do have with the principal, and eventually other interests held by them within the structure itself in the investee. So those were the four major aspects in IFRS 10, and in fact there are some principles in assessing control that are within the IFRS 10. One is to consider the purpose and design of the investee. This generally identifies who has the control. The activities, what we call the relevant activities, identify which activities are those and how decisions associated with those activities are taken in the day-to-day process. The ability to direct relevant activities. Who is the investor, who has this ability, and how they direct these activities. The returns provided by the investee, and how the investor is exposed or has rights over these returns. And finally, the ability to use the power over the investee that could affect their own returns. So with those sort of general principles in assessing control, we believe it would be easier to assess in many situations. I would just pass on very quickly. Those are examples that are directed from IFRS 10. Those examples are mainly self-explanatory, and we discussed some of them actually before. I will simply move a little bit ahead because of the time constraints and talk a little bit about the exception on investment entities. So as a general principle, if you control the entity, you have to consolidate. And in October 2010, we published an amendment to IFRS 10 with an exception to all subsidiaries, that all subsidiaries should be consolidated, and this exception is for investment entities only. So, and we characterize investment entities as one who has three features. First, obtain funds for providing investment management services. This is basically its activities. Has clearly as a business purpose the investment of the funds obtained by third parties for returns from the investment, income or capital appreciation. So they gather a bundle of funds and invest in many entities, or only to provide returns based on the investment itself, could be dividends or capital appreciation associated with them, and also measures and evaluates its performance on a fair value basis all the time. So if it's an investment entity with these characteristics, there is an exception to IFRS 10 to those entities. So the accounting for those entities under IFRS 10 is that they should measure all the investments at fair value through profit and loss. So if they are identified as investment entities, they measure at fair value, and you saw in the session before some of the requirements for investment. And if the parent of the investment entity, if it's not an investment entity, it should consolidate all controlled entities, included the ones controlled by the investment entity subsidiary. So in short, if I am an investment company and I control a bunch of investees, I would value them at fair value through profit and loss. However, if there is a parent of this investment company, they have to consolidate all those investments. So it doesn't pass through and they consider fair value through profit and loss as well. So there will be two levels of accounting treatment. Investment entity, fair value. Investor or controller, parent company of the investment entity should control all the investments, even the ones not consolidated by the investment entity. So this was published in October 2012, and also just in time for implementation for effective date of IFRS 13. So in summary, what IFRS 10 brings a single measure for consolidation based on control that applies to all entities. There is no entities out of this except basically investment entities. The consolidation is based on control. We sometimes characterize this model as power so as to benefit. So I have the power to associated with all relevant activities, and I benefit, or I am exposed to the returns generated by my investing. And the power generally arises from voting rights, but we do see some situations where the power arises from other structures. For you to follow then IFRS 11 and 12 on disclosure, this is the interaction between IFRSs 9, 10, 11, 12, and 28. So as you see, if there is control, you go directly to IFRS 10. If there is no control alone, if it's a joint control, then you follow the requirements on either IFRS 11, define if it's a joint operation or a joint control. And if there is no joint control, you consider if there is still significant influence. If there is still significant influence, you treat in accordance with IAS 28. Or if there is no significant influence, you treat in accordance with IFRS 9.
What about
Cost. 28. IFRS 28. Cost or equity or fair value. So with that, I will give the floor to Mariela, 5 p.m. Yes?
Does the principle of materiality from the Conceptual Framework
Materiality.
applies to IFRS 10 regarding the principle that all subsidiaries must be consolidated?
Well, what we say is that the principle of materiality applies to all IFRSs in general. We tend not to refer to materiality in individual standards. Why? Because it's a principle that should be considered when applying any standard. So it also applies, could apply. So if the principle is you consolidate everyone that you control, but eventually if it's not really material, you can reach a decision not to consolidate because the cost benefit is unbalanced, so there's more cost than benefit, or doesn't represent it's not a faithful representation, or it's not useful for users in the decision-making process. So the materiality principles applies to any IFRS, actually. We do not tend to mention in standards individually. Okay? Mariela, please.
Hello again. I will be presenting the standard on joint arrangements, which is IFRS 11. And this standard deals with arrangements that are governed under joint control. If we don't have joint control, it's the first assessment that we have to do. We are not going to be in the scope of the standard. So that's a key feature of the arrangement that we will be talking about now. So as Amaro said, IFRS 11 forms part of the 5 standards that were published in May 2011, IFRS 10, 11, 12, IAS 27, and IAS 28 suffered some amendments as a result of those standards. And it replaces IAS 31, which was a standard that had not a major revision since '93, so it worked well for a number of years. And it replaces completely IAS 31 and an interpretation that is 613. The disclosures are not in IFRS 11, but in IFRS 12, the same as Amaro was discussing for subsidiaries and structured entities. And the standard is effective from 1st of January this year, and earlier application is permitted. I don't normally introduce the standard with an effect analysis, but I thought that for this audience would be relevant or also interesting to know, to have a flavor of the population of arrangements that could potentially be within the scope of the standard. And to do so, we published, when the standard was finalized and issued, we published an effect analysis. And I got the first 2 slides of this presentation from that effect analysis. You can find the effect analysis in the website at the IASB. And you can see from the first chart shows the trend in the volume of JV deals worldwide in the last 2 decades. We took the data from a database and from an academic paper, and basically the data compiled all the worldwide JV transactions from filings with the SEC, from trade publications, new wires, and other news sources. And what we can see in that trend is that the volume of JVs reached its peak in '95, and from there it basically decreased. And there are some reasons why the trend went down. And some people justify this because of the liberalization of foreign investment regimes. Other authors state that it is caused because of a managerial failure and frustration from those arrangements. And we can also see that in the last couple of years, 2009 and 2010, from that trend, the drop is remarkably, and we think that the financial crisis had an effect on corporate combinations, and that's why the number decreased so much. In terms of countries and in industries, what we see is a concentration. JV deals are concentrated on mainly 10 countries, and those top 10 countries basically represent about 66% of the total JV volumes during the last 20 years. And in terms of industry, basically the same. The 10 top industries represent 57% of all the total volume of JVs during the last 2 decades. Of course, not all of those JVs that are being shown there will be in the scope of the standard, because again, the standard only deals with arrangements that are governed through joint control. And joint control is a specific way, it's a particular way whereby the parties share control of an arrangement. And it is when the parties decide on unanimous consent on the decisions that matter. So the parties establish that unanimous consent is required to decide on those decisions that give the parties control of the arrangement. And as a result, not all of those arrangements in the last 20 years have been structured through joint control. There might be some arrangements that are structured based on a majority decision-making process. So we're talking about a subset, but this is only to give you a flavor of the trend and the population of the items. So high concentration, so trend is decreasing, and high concentration in countries and in industry. And another data that we found very interesting and very useful to understand the impact of the standard is how are those JVs structured. And we got this information also from the database. And the database told us that about 2/3, so 63% of the arrangements were structured through a contract. So there was nothing else than a contract between the parties. And the database called those arrangements strategic alliances. And a third, so 36% more or less, were arrangements where the agreement between the parties basically created an independent firm. So the arrangement was structured through an independent firm. And this is not, it is anecdotal, but not that anecdotal, because you will see that it gave us a flavor and a rough estimation of how much the changes brought by IFRS 11 could impact the population of the arrangements within the scope of the standard. You will see in a minute. In terms of industries, we also have that in most of the industries, the structure that is predominant is also a contract, just a contract. And in terms of countries, what we found is that more mature and developed countries used more predominantly strategic alliances, just contracts, whereby countries that were more developing or emerging used more independent firms as a structure to set up those arrangements. So if we go to the effects of the standard, I think that before assessing the effects, it's better to compare with the previous standard. And what we had in IAS 31, we had that the standard presented 3 types of arrangements: jointly controlled operations, jointly controlled assets, and jointly controlled entities. And you have underneath the labels of each type of arrangement the accounting. And jointly controlled operations and jointly controlled assets, the accounting resulted in a gross recognition of assets, liabilities, revenues, and expenses. For jointly controlled entities, those arrangements were structured through an entity, and entities had an option. They could choose between proportionate consolidation or equity method. This is the starting point. Now IFRS 11 appears, and IFRS 11 presents 2 types of arrangements that will result in 2 types of accounting, again gross or net, and we have joint operations that will result in the recognition of assets, liabilities, revenues, and expenses, and we'll have also joint ventures. When I was saying that the data about the structure is not only anecdotal and that it's important for us to understand the effects, it's because of the following. In IAS 31, jointly controlled operations and jointly controlled assets were arrangements that didn't have an entity. So we are talking about contracts between the parties that are doing an activity together under joint control. So we are just talking about contracts. And those type of arrangements will fall and will be joint operations in IFRS 11, and that's the same accounting. So that means that for jointly controlled operations and jointly controlled assets in IAS 31, there will be no changes in IFRS 11. And if we go back to the database, we found that arrangements that were just structured through a contract were 2/3 of the population. So that means that 2/3 is a rough estimate, but that means that 2/3 of the population will be joint operations and there will be no changes from the new standard. And jointly controlled entities could be analogized with those JV deals that were structured or set up through an independent firm. And those were just 1/3 of the total population. And from that total population, now we will see that they could be either joint operations or joint ventures. We also estimate that the majority of those arrangements will be joint ventures, and the change will depend on whether the entity in IAS 31 was previously using proportionate consolidation or equity method. So if they were using equity method before and now the arrangement is a JV, then there's not going to be any change. If they were using equity method but now they have a joint operation, then there will be a change. So this is to give you the main vocabulary, so the names of the arrangements and the accounting, and to provide you with a flavor of the change. But I'm not explaining you yet what is the principle behind IFRS 11 to get to the classification. I haven't explained you what the standard assumes and assesses to classify between joint operations and joint ventures. We will go through that in a minute. Before IFRS 11, we said that we had two accounting options for jointly controlled entities. We had proportionate consolidation, which is in lila there in fuchsia, and equity method, which is in yellow there. And it pretty much varied among jurisdictions. And we found that in a survey made by a big accounting firm, they surveyed 199 entities, and from those 199 companies, 144 had jointly controlled entities. And from those 144 jointly controlled entities, 50 were accounted for under proportionate consolidation, 50 were accounted for under equity method. We had 50-50%. And why is this useful then? Just to give you the final overview of the effect of this standard. So we start with the population of JVs, and we said that 2/3 are strategic alliances, 2/3 are just contracts. We explained before that if these were just contracts, we won't have any change in IFRS 11. So we will have to be very cautious in the classification of that third. When we do have an entity, we have to assess whether we have a net investment or whether we have assets and liabilities on a gross basis. This is basically the decision-making process that is key in IFRS 11. So if we have an independent firm, which is 1/3 of the population, from that other survey, we learned that 50% of those were accounted for under equity method, and then 50% were accounted for proportionate consolidation. And based on the classification criteria of IFRS 11, those will be either joint ventures or joint operations. And the effect will depend on what was the method used before by the entity when applying IAS 31, and based on what is the type of arrangement that they have now in IFRS 11. But this is to give you a flavor of the changes that IFRS 11 is putting through. If we have that an entity was using proportionate consolidation, and now it is a JV, and you have it on the left-hand side, proportionate consolidation, and now this arrangement becomes a JV, then we will have a change from proportionate consolidation to the equity method. And if you analyze, this is a very brief overview of the changes in each of the statements of the financial statements. You will see that, of course, if you come from proportionate consolidation to the equity method, the statement of financial position and the statement of comprehensive income and the statement of cash flows suffer a shrinkage. So we don't have any longer those assets and liabilities because we have just an investment. We don't have reported figures for revenues and expenses, and we don't have cash flows from operating, investing, and financing activities. There's no changes in the statement of equity because net income will be the same under proportionate consolidation and under equity method. So these are the most remarkable changes in presentation of the financial statements from proportionate consolidation to equity method. If we go to the key ratios, because we don't have a change at all in net income and we don't have a change in shareholders' equity, we don't have changes in return on capital. We might have changes in the different ratios that are components of that return on capital. We have an increase in profitability because we don't have the revenues anymore. As a result, the denominator will be smaller. We have an increase in profitability. We have a decrease in leverage because we don't have the debt anymore. And assets turnover will depend based on the changes, the absolute and relative changes of revenues and assets. These are the key changes in ratios, and when we were doing this effect analysis, we learned that analysts could not expect that those accounting changes would impact in the share prices of the entities having those type of arrangements. When we were developing IFRS 11, we received feedback from the banking industry and from regulators. And specifically in particular, we received 2 letters from regulators when ED9, which was exposure draft before IFRS 11 was published. And the main feedback that we received was that the exposure draft was not clear enough, the main concepts needed more development and more work, and that the board had to make a clear statement, and it was not sufficiently clear why proportional consolidation had been removed, basically. After the comment letter period, we received another feedback from another regulator based in Europe, and that regulator estimated that the frequency and the significance of joint arrangements was only going to be limited to specific institutions, and that the impact on the capital requirements was going to be little from the new standard. And but basically this regulator told us that it preferred proportional consolidation, and it gave 2 reasons. The first one is because it was perceived that proportional consolidation gave greater transparency for institutions and investors, and it provided more information. And the second one was because by accounting for the equity method, we have the net income there, but we don't have the assets, because we are now condensing everything into a single line. We have lost all of the assets, and risks based on a regulatory perspective are better reflected on a gross basis. And basically, by not incorporating those assets, but incorporating the profit, it was perceived that the standard could increase the risk-taking potential of some institutions. So that was the main feedback received of why they were against their removal. I will skip the following one because it doesn't provide more detail or clarity to the presentation that we are doing right now. But what I will have to explain is that while even though we received the board received such input, why IFRS 11 kept developing and why the requirements are the way they are, what used the board to develop those requirements. And I found this quote from Risk Magazine, from a banking regulator, and basically what it illustrates is that we do have different frameworks, regulation and accounting, we do have different frameworks because we do have different interests and different objectives. And now it's my turn to explain you why the board thought that in some instances it was not appropriate to keep then proportional consolidation. I will be more precise now why I said in some instances. Well, what the board didn't like about IAS 31, what it needed to be improved, it was that basically the accounting, which is the last line of the screen, was driven by the structure of the arrangement. So if the arrangements were not structured through an entity, then we had a gross accounting. But if the arrangement was structured through an entity, then we had jointly controlled entities, and then we had an option. And options impair comparability, and whenever possible, they are removed. And to remove the option, then the standard needed to provide a principle. So how do we classify arrangements? How do we say that some arrangements need to be accounted for on a gross basis? How do we say that some other arrangements need to be accounted on a net basis? And the board followed basically these principles. And it's a principle that you could say, well, this can be applied to any type of transaction, to any type of situation, to any type of standard, so it is a principle that is so general that it cannot be wrong. Because what the standard says is that parties to a joint arrangement should recognize their rights and obligations arising from the arrangement. So it is based on the assessment of the rights and obligations when we are going to be having either joint operations or joint ventures. So if the parties have rights and obligations from the contractual arrangement that gives them rights to assets and obligations for liabilities, then they have to account for those assets and for those liabilities on a gross basis, and these type of arrangements are called joint operations. If the parties from the contractual arrangements, they only have a right to a net asset, to an investment, and to the returns from that net asset, the most appropriate accounting method is equity method, and this is what they need to do. So the accounting is driven by the analysis and the assessment of the parties' rights and obligations. And this is not trivial either, because it has to be enforceable. It comes from the contracts between the parties, but whether a specific term gives rise to an asset, to rights to an asset or obligations for a liability is not that trivial. In some cases it's straightforward and there's not much analysis, but in some other cases we found that constituents are not that used sometimes to perform such analysis, because they were used to a very, very easy standard that said you have an option, either proportionate consolidation or equity method. And now this standard says, well, you have to make an assessment based on this principle. And sometimes contracts are very clear and they explicitly state what are the parties' rights and obligations. Sometimes are not that clear. And the classification is more challenging. So these are the two main assessments that an entity needs to do when accounting for its arrangement. Basically, the first one is that arrangement in the scope of the standard, yes or not? Do we have joint control, yes or no? But the second one, it is key because it is really the new, the core and the new requirements of the standard. Is the modifications that the standard is doing to IAS 31. And that classification will lead to joint operations on joint ventures, and the analysis and the classification exercise will depend on the parties' rights and obligations. So basically, an entity will have to determine whether it has rights to assets and obligations for liabilities, or whether it has rights to the net assets, to an investment. And the square, the rectangular, the front rectangular on the screen shows and includes the main raw material, the main indicators that an entity needs to follow to assess those rights. And the first thing that it will consider is the legal form of the entity, because when are we going to have a problem in the classification of the arrangements is when those arrangements are structured in a separate vehicle. So if those arrangements are just a contract, we don't have a problem in the classification, because those arrangements will end up in assets and liabilities. Those arrangements will directly go to joint operations. But if we have an entity, is when we do have to determine who has rights and obligations. Do the parties have direct rights and direct obligations for the assets and liabilities, or it is the entity within which the arrangement is being structured, the one that has the rights to the assets and the obligations for the liabilities? So we have to basically assess who is the one that has rights and obligations. Are the parties directly, or it is the entity within which the arrangement has been set up? And to do this assessment, then we will have to consider the legal form of the entity. We will also have to consider the terms of the contractual arrangement, and what the standard calls other facts and circumstances that are also contractual terms that are enforceable, and that basically would tell the parties that they have also rights to those assets and obligations for those liabilities. The presentation follows with two examples. that basically the first one is when the arrangement has been structured in an entity. The entity is, for example, a corporation, and based on the analysis of the legal form of the corporation, we would conclude that it's the entity, the one that has rights to the assets and obligations for the liabilities, are not the parties, but the entity. So the first square says, does the legal form of the separate vehicle give the parties rights to the assets and obligations for the liabilities? Well, no, because it's a corporation, and it is the corporation the one that holds those rights and obligations. So we would go down, and what we would need to assess is whether the agreement, the contract between the parties, state that even though they have structured the arrangement through a corporation, even though they have done so, if the contractual terms agreed between themselves can override and reverse this, then we might have gross accounting, we might have assets and liabilities, and we might go then to your left, to joint operation. And this is the first example where an entity has structured the arrangement in an entity. So the first step would say, well, we might have a JV, but what happened is that the parties have agreed in the contract that they do have rights for the assets and obligations for the liabilities. And the third bit in here is when there are no explicit terms that tells the parties that they have rights to the underlying assets and obligations for the underlying liabilities, but what happens is that the arrangements have been designed explicitly and exclusively to provide the parties with an output, and the parties have agreed, are committed to purchase this output. They have an obligation for the purchase of this output. So we are talking about something that is enforceable and is coming from the contract, even though it's called other facts and circumstances, it's a contractual term. They are committed, obliged to purchase the output. And what they have done is they have studied at the price at which they will use to purchase this output. And this price, what they will do is, through the price, they will cover fixed costs and some other cost of productions and administrative expenses. So they have studied what is the price that would cover those fixed costs. And basically by doing so, they are making themselves responsible for the liabilities that the arrangement will incur to produce this output. So they have a commitment to purchase the output, and they have put a price that covers the main fixed costs, and because they are committed to purchase the output, they have the obligation as well to pay the arrangement. And this is the only type of example where the board also concluded that that would be also a joint operation, even though the arrangement might have been structured through a corporation, and maybe we don't have a very explicit contractual term that tells the parties you share everything 50-50, for example. Well, the standard is because the board has included the principle, and the accounting is following that principle, then we do have that verifiability and understandability are enhanced, because we know that if the parties have rights to the assets and obligations for the liabilities, those will be represented. If the parties have rights to net investment, that will be represented as well. So we don't have accounting being used for arrangements that represent different rights and obligations for the parties. So similar rights and similar obligations will have the same accounting. We have consistency because we have gotten rid of the option, and we have more comparability as well between financial statements and between arrangements that give the parties similar rights and similar obligations. We will have the same accounting as well. For disclosures, I will basically go to the last slide, I'm afraid, and I will because I think that's the most relevant change that IFRS 12 in that case has put forward compared to IAS 31. And what the board tried to do in here is that for joint ventures that are being accounted for under the equity method, IFRS 12 requires some additional disclosures in the summarized financial information. So under IAS 31, the summarized financial information was a requirement, but entities were required to provide this on an aggregate basis. Now, IFRS 12 says that those summarized financial information needs to be provided on an individual basis for each material joint venture. And the new additions are highlighted and basically aim to give a rough idea of what is the net debt position of each material JV, to give more information about the profitability of each material JV, and also a rough estimate of what would be the operating cash flows. Because if you can build a rough EBITDA using some of the captions in the income statement, and EBITDA in some cases is seen as a rough estimate of operating cash flows. So all of those additions in the disclosures are aimed to provide better understanding and better information about the net debt position, profitability, and cash flows of the entity. And with that, I would conclude this session on joint arrangements. Thank you.
Thank you very much.